All right, now, so yeah, we have that data. Nigeria's GDP, that's another sustained a growth there, about 3.46% year on year. That's in real terms for the third quarter. We have that data. I was out sometime late yesterday, and now we have to break it. According to the National Bureau of Statistics, this is higher than the 2.54% growth in the third quarter of 2023 and the 3.19% growth in the second quarter of 2024. And all of this is happening despite the rate hikes so far. But joining us to discuss this and what to expect for the rate setting meeting, that's tomorrow. That has started today. We'll get a decision definitely tomorrow. Joining us now, we have Mr. Tajuddin Ibrahim, as a director, research and strategy at Chapel Hill Denham. Great to have you on the show.
Thank you for having me on the show.
So how are you seeing this data? First of all, did you expect this?
So I would say that we expect it because our forecast at Chapel Hill Denham is for the economy to grow by 3.50%. And now that the growth number has been reported at 3.46%, I would say it is broadly in line with our expectations. And it is stronger in terms of, Bloomberg consensus. When you look at what, some other economists were forecasting, we have an average forecast of about, 3.0% by, Bloomberg consensus. So the growth rate is much stronger than, market expectations.
And definitely, with a population of over 200 million, should we be celebrating this growth rate we're seeing? Or what should be our growth rate, really?
I think we should not be, celebrating this growth rate, considering that it is just, very similar to what we have in terms of, population growth. But I reckon that it is a progressive, growth rate when you consider the growth rate that were recorded in the second quarter and also in the first quarter. And speaking to what sort of growth number should Nigeria be reporting, given our large population and given the huge resources that we control as a country, I think Nigeria should be reporting nothing less than double-digit real GDP growth, assuming that we put all of the resources that we have together, both human resources and also non-human resources, particularly speaking about the natural resources that we have, assuming that we are able to effectively put all of those into action. Nigeria, naturally speaking, to my mind, should not be talking of economic growth that is less than double digit in my view. And I think possibly a worst case scenario is for us to be recording high single digits of like 9% or not less than 8% over the medium to long term. But we have a long way to go to achieve all of these numbers.
All right, what does this tell us about the rate hike so far? I think we've done about over 800 basis points, and we're still seeing some kind of growth, if you're comparing this quarter on quarter.
Yes, I think about the rate hike, what this growth number, tells us is that, it is saying that, the impact of the interest rate increases by the Central Bank of Nigeria is not, the same across, key sectors of the Nigerian economy. The numbers published by the National Bureau of Statistics have shown that, the growth rate of some sectors have, declined over time, while the growth rate of some sectors have increased, over, a similar period. The telecommunications sector in this case has recorded much lower growth rates compared to what we saw about 6 quarters away. While on the other hand, the financial institution sector has actually seen the strongest growth rate within the past sort of 7 quarters. Specifically speaking, the fastest growing sector in the third quarter of this year is the financial institution sector. So which means that the impact of the rate hike is uneven, when we are looking at the broad sectors of the economy. So I think that is what is playing out. It has been broadly favorable to some sectors, while it has largely speaking dampened the performance of some other sectors. And I reckon that the financial sector in this case is the winner.
And let's try to imagine now that we didn't have over 800 basis points of rate hikes. Would the growth be higher?
So the growth, to my mind, naturally speaking, should have been higher, because what has happened is that the higher interest rates are sort of slowed down. The plans of companies, generally speaking, in terms of borrowing to expand, businesses. There are a lot of companies that I believe are currently delaying, their investment plans for growth, largely because we have an elevated interest rate environment. That is also indicative when you look at what is happening in the capital market. Naturally speaking, you will see more companies come to the capital market to raise debt capital to support, their business growth, to acquire equipment for expansion of their businesses. We currently are seeing a slowdown in that regard. And I think that is what, we will see over the next, couple of quarters, in as much as monetary policy remains tight. By the time it begins to, go dovish, most likely we will see a return to a much stronger growth rate by then.
This shapes the decision tomorrow by the MPC, that's the Monetary Policy Committee.
I think the monetary policy, tomorrow would have no option than to remain, tight in terms of, monetary policy. And I think, the stronger growth rate that we have seen in the GDP growth for quarter three is another compelling case for them to remain, tight in their monetary policy. And most likely, we are going to see them increase interest rates by what looks like 25 to 50 basis points, just to curb the rising inflation rate that we have seen so far this year.
And what are you seeing for the fourth quarter report? Do you think we'll see this growth sustained going into, we're in Q4 now, but when we get the Q4 results?
It is important to point out that the Q3 2024 economic growth, which printed at 3.46%, is spot on the same growth rate that Nigeria reported in the fourth quarter of 2023, which was, a festive, quarter, and so was underpinned by festive, spending. So if we are recording 3.46% in the third quarter of the year, it looks to me like the final quarter of this year will be much stronger in terms of, economic growth, bearing in mind that it is a seasonally strong, quarter in terms of, the festive activities, and also the spending that, is related to, festive activities by Nigerians, and also, by other, people that travel down to the country to celebrate the festive period. So I reckon we could see, much higher growth rate in the final quarter of this year. What looks like 3.5 or 3.55% comes to mind in that regard.
And also, we also have more data from the NBS there, and that's for unemployment. And that came about 4.something%. But, looking at that data, we know interest rates, they have an impact on growth and employment. So looking at the data, that unemployment data there, what is it telling us so far?
Unemployment data, we bear in mind that they changed the method of calculation. 4% plus is to my mind not really the kind of unemployment rate that we have in the country. But for the change of methodology, over 4%, is the number that that is being reported, I think that number is not fully reflective in my mind, of what Nigerians are facing. I reckon the number, is much, higher than that, and it speaks to what the government has to do. We have to move away from, methodology induced, impact on our economic indicator. We should focus more on direct intervention in the economy by providing more jobs, to Nigerians, particularly the youth, and also importantly, creating the right, enabling environment for the youth to be able to operate and also lift the growth rate of this country via several activities. So I think, that unemployment rate, to my mind, is reflective of just, change in methodology. In reality, I reckon it is much higher than that.
All right, thank you so much. Always great to have your perspective. That was Mr. Tajuddin Ibrahim, Director, Research and Strategy at Chapel Hill Denham. Thank you so much for coming on.
Thank you for having me.
All right, we'll take a break now. When we come back, we'll head straight to the markets. Just stay with us.